A pause doesn't mean we're on the precipice of a whole easing cycle. I think it's highly likely that the pause will demonstrate the economy is doing pretty well, and I think investors and the Fed alike won't necessarily have a problem grabbing a few more insurance quarter-point rate hikes. At least that's the way I see it. But the data was even more important in so many other ways. Of course, we haven't had a lot of data with the partial shutdown. We discussed this yesterday. And I think that was a variable in the market, especially interest rates pulling down. Today, the strong data, the 2 months average together for jobs, even with the big revision, the last look, is 263,000, 6 months in a row, 3% or higher on average hourly earnings year over year. But maybe the most important aspect to this is that even though Peter is right that we will feel the effects of overseas, I don't look at the consumers holding things up. I look at us that we're lucky that the consumer is strong. Tax reform is helping them no matter what people say, and I think that will continue. And I think investors will be more prone to invest in the U.S., and I think that indeed will give the equity markets a boost as well.
Peter, despite that, if the data overseas does continue to soften, what do you expect to happen to the dollar, even though we have a fairly dovish tone from the Fed expected to last at least for half of this year?
Well, I'm amazed at how well the euro trades, how well the yen trades against the dollar, even the Chinese yuan that's trading against the dollar. Now, I think a lot of that certainly has to do with the easier Fed now and the more dovish approach they're taking to monetary policy. But I also wonder whether the rising debt and deficits is really beginning to impact the action in the dollar. I mean, if you look at Europe, Germany's going to grow 1% this year, estimated. In fact, for the entire Eurozone, you'll have a one handle on growth. The political issues, negative interest rates, 40% of the ECB balance sheet relative to GDP, and the euro still trading about 115. I think that says a lot about the challenging situation that the dollar is in, and that the Fed dovishness is just adding to that.
So, Rick, what about the other data that we got today? How much of it is meaningful given the shutdown, given all the delays and the fact that it's sort of backward looking? And what sort of economic signals should we look for to get a clean read on what's going on?
You know, I love market forensics, Sarah. If you take a 2 or 5 minute chart of any instrument on the curve and you look at it, the 8:30 Eastern data definitely helped. But it was the 10 o'clock Eastern data that really propelled rates higher. It was the strong ISM. It was a better read on the final January University of Michigan than the mid-month read. Construction spending rebounded, was very strong. The only fly in the ointment on the 10 o'clock data was the wholesale sales side, which was down 0.6. I think that those data points quickly gave investors some optimism that during that blackout period where they couldn't see some of these data points, what's showing up shows that we really didn't miss a step. Granted, not as good as a year ago, but much better than many were thinking just several sessions ago.